George Blower, and Mark Nolan and I are here from My Solo 401k Financial. We really appreciate the opportunity to be here. And the presentation that we wanted to share, we brought a lot of slides in case I would say we want to go deep on some issues. But because I think we got about an hour, right, to go through these.
Right.
So I would suggest that we make it interactive, but maybe we can try to go through these slides just to get the conversation going. But as you can see from the title, the presentation is focused on a solo 401k for realtors, which is awesome because we have tons of realtors in our client base, and we want to talk about the power of the solo 401k. So really taking an educational approach, and there's multiple use cases, and it can be a very powerful tool. The number one area we're going to focus on is contributions. So of course, that's all around saving for retirement, the tax benefits, right? Because 401k contributions are tax incentivized, whether it's reducing your taxable income now or maximizing contributions that go into a Roth account so that you have the potential for tax-free growth. And so in addition to that, we've also brought a couple of slides on other use cases, which would be like real estate investing or taking a 401k loan. So we can also talk about those because those are really the top three, I would say, use cases or as far as the power of the vehicle. So let's get started with some housekeeping. Mark and I will kind of take turns on going through these slides. So of course, it's being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor is it solicitation. When making an investment decision, please consult with your tax attorney and financial professional. We do want to highlight some of our resources. So we have a community, which is totally free to join. All are welcome. It's at mysolo401k.net/my community. We host a daily Zoom call on there at 1 p.m. Pacific, 4 p.m. Eastern. So it's kind of like office hours, right? We might bring a couple topics to talk about, or we just go through questions. And, that could go from 30 minutes to an hour, just depending on the number of questions that folks have. We also have forums where people post questions 24/7. We've been updating our video library. So we've got a couple hundred videos in there, all educational type videos. So what I'll do is I'll start to just lay the foundation, right? Because of course, we can talk all day about all the ways you could use the solo 401k, but of course you have to be eligible to set up a solo 401k. And the great thing is, if in our experience, right, many realtors are self-employed. So a 401k plan, the way that I think about it, right, is that a 401k plan is for employees, but a solo 401k plan is for a self-employed individual. So in order to be eligible to set up a solo 401k, you have to be self-employed with no non-owner, non-spouse, full-time W-2 employees working for you. So it's like an owner-only business. So maybe somebody that receives a 1099 NEC or miscellaneous, right? And so that type of person would be eligible to set up a solo 401k. Now, as far as some of the top eligibility considerations, right, you don't have to have a formal legal entity. You could have a spouse or business partner that participates in the plan as long as each person is reporting self-employment income. So there's no minimum amount of self-employment income that you need to report to be eligible, right? But you want to report at least self-employment activity. So if you are a sole prop, right, you get that 1099 NEC, then you're filing a Schedule C on your tax return. So that helps to document and demonstrate that you are self-employed. And then if you also have a spouse that's working in the business or a business partner, if that person is also reporting self-employment activity from the same business, then each person can participate in that one plan. And it's still considered a solo 401k. We just charge one fee, right? It's still, you would have separate sub-accounts for each person, right? It would just be considered one plan. More popular eligibility questions would be around, okay, what if I have a day job, but I've got this side business? Can I set up a solo 401k? The answer is yes, right? The fact that you have a day job, the fact that you participate even in your day job 401k plan is not going to stop you from being able to set up a solo 401k for your self-employed business. So I'll go through the setup process and then we'll let Mark come on. So just real quick on the setup process, the way that I think about it is that a solo 401k is a legal entity, right? It's technically a trust because those assets in the plan are held in trust for your future benefit, right? When you retire, right? So it's not a personal asset you can use now, without restriction. It's not even a business asset, right? So if your self-employed business were to get sued, right, that's not a business asset that would be vulnerable to, satisfying a judgment related to your business, right? So there's some creditor protection elements to that solo 401k. So it's a trust again, right? So it's a legal entity. So it's the documents that create it. So we are a 401k plan provider. We have IRS approved plan documents that we would use to set up a 401k plan for your business. So we draft those documents within one business day when somebody signs up. And then we guide the client through the process to open up an account for their solo 401k at the bank or brokerage of their choice. So we don't hold or have access to any of our customers' money, but we're helping them. We're very hands-on in helping them every day open up accounts at hundreds of different banks, credit unions, brokerages like Fidelity and Schwab. And then the next step would be to fund that account. So people are funding it by really two ways, right? They're either contributing to the solo 401k, where they're taking some of their self-employment income and they're making a contribution, or they're rolling money over from an existing retirement account, right? It could be a former employer plan or an IRA. So, we are preparing the transfer paperwork, we're answering questions about contributions. And then once that account is funded, right, it's time to use it, right? Whether that's taking a 401k loan or making it a particular investment. So, and then, you're zooming in a little bit, right? I mean, there might be multiple different accounts. If you've got, say, the husband and wife, right, that are both working in the same business, right? It would be, again, one plan, but each person would have their own account, or it could be different types of money like pretax and Roth. So as we are onboarding someone, we're going through all those details and getting the requisite number of accounts set up. And like I mentioned, you can roll over money. You just can't roll over money from a Roth IRA because of that's the way that the Roth IRA rules work. So now I'll flip the slides, but let Mark take us through the next set of slides here.
Hello, everybody. Thanks for the opportunity to go over the solo 401k with you. So, just like all types of financial products, you've got compliance requirements. And that's especially true when we're talking about retirement accounts, like 401k plans for the self-employed. So that's where we come in. So not only do we provide the actual plan that allows you to invest in alternative investments such as real estate, for example, but we also take care of the reporting for the plan in conjunction with the trustee of the plan, which is the business owner. So let me make sure I've got this. Get to this. I don't think I've got control over the PowerPoint, but I'll let George kind of guide those slides there. So there's various reporting that applies to a solo 401k plan. It really depends on certain factors. For example, the market value of the plan. So the plan may hold some cash. It may also hold actual real estate properties. So you have to combine the value of all the assets in the plan, those properties and any liquid funds and any other investments, whether it's equities or other types of alternative investments like trust deeds. That's another popular investment with the solo 401k. I'm sure you guys have heard of trust deeds being in the real estate industry. So the reporting is that applies when the value goes over 250,000 in market value is a Form 5500 easy. It's an informational return. So it's a way of communicating to the IRS on a yearly basis the total value of that plan. It gives the IRS a snap picture of the account. So that's something that we will perform for our clients. And that return is actually filed electronically with the Department of Labor, and we handle that. Moving on to the next slide, which is the bank account. That's not really so much a compliance item to discuss, but that bank account slide really talks about how the plan has a separate bank account to hold the funds, because a solo 401k is a retirement trust. So you have to separately account for those funds from your business or your personal funds. You can't commingle them with your personal or business bank accounts. There can also be a brokerage account, which is the next slide. And the brokerage account is similar to the bank account in that it's a holding account for the 401k, which means that if you want to invest in equities, you can do so through this brokerage account. Well, the brokerage account will also allow you to invest in real estate. And we can talk about that more later, but the takeaway is that the brokerage account is different from the bank account in that the brokerage account will allow you to not only invest in equities, but also real estate. And the reason for that is because we're the ones providing the plan, not Fidelity, Schwab, or TD Ameritrade. So they will provide a brokerage account or brokerage accounts for this type of plan. Don't get confused, because they also have their own solo 401k, but their plan is restrictive in that it cannot be invested in real estate, for instance. Okay, yeah, we kind of got a little bit turned around with the slides, but again, we'll continue to work with it here. So then we've got a transfer rollover slide here, and this just explains more of how you can transfer an IRA, a former employer plan, to the solo 401k. And that's a way to supercharge your retirement account, because as you can probably gather, real estate's expensive. So you're not going to be able to find a property just by making an annual contribution. Well, by transferring IRAs and former employer funds, that's how clients quickly get funds in there in a large chunk so that they can invest in real estate. Next slide, we're going to go into the benefits of the plan. So from a contribution perspective, and this is what George was touched on earlier, with the solo 401k, you can really sock away a lot of money for retirement, especially when you compare it to an IRA. An IRA, you can only contribute $7,500, for instance. Well, with the solo 401k, as you can see on this slide here, you can contribute, and these are all 2023 figures. You can contribute $66,000, or if you're over age 50, if you're 50 or older, all the way up to $73,500, and that's per participant. So that means if both spouses are self-employed in the same business, you can both participate in the same plan, so you can each put in the $66,000 figure to the plan as a contribution. And you can break it down into, you can break those contributions into Roth contributions, pre-tax contributions, voluntary after-tax contributions. And then you can then invest those funds in alternative investments like real estate, for instance, or even real estate syndicates. You can also borrow from the plan. So take a participant loan. I'm sure you're familiar with that, where you can borrow from your current employer's 401k plan. Same concept here. And each participant can borrow from their respective solo 401k funds. And as you can probably imagine, borrowing from the plan, you can use those funds however you wish, whether it's to invest in real estate outside the plan, so not in the plan, but outside the plan, or for other reasons. There's really there's no restriction as to what you can use the funds for once you borrow from the plan. So now we're back to the contribution slide again here. Do you want to pick that up, George, or do you want me to continue?
Sure. Yeah, I
Okay,
can
go
take
ahead.
over. All right, awesome. So yeah, so let's zoom in more on the contributions. So again, I want to give us time to have questions and a conversation, but so we've got a number of slides here. We can go deep if people want to go deep on the contribution rules. But as Mark was saying, the solo 401k plan, it has the highest contribution limits for any defined contribution plan available to a self-employed person, right? We talked about how you could contribute as much as $66,000 or even $73,500 if you're 50 or older, and that's per participant. Now, part of the value that we bring is we're helping clients every day, educating them on those contribution rules. So those contribution rules, it's going to depend on multiple factors, right? One concept, again, is that you can't save more than you earn. So your ability to contribute is going to be limited to your self-employment income, right? If you're 50 or older, right, you're able to save more because you can make what's called a catch-up contribution, and that limit is $7,500. One of the consequences of inflation is that there was one of the biggest jumps ever last year for 2023 in how much you can contribute to the plan. So the catch-up limit went up from 6,500 to 7,500. The overall limit went from 61,000 to 66,000. And it's anticipated that it won't be as big of a jump for next year, but there will be additional increases. And then part of the analysis is going to be, okay, well, what type of contribution are you looking to make? Are you looking to make an employee versus an employer? So part of the reason that you can contribute such a high amount to this self-employed 401k plan, remember a solo 401k plan is for a self-employed individual, is that you're able to make contributions as both an employee as well as an employer. So let's assume that the business is taxed as an S corp, just because it'll be easier to get into it. Your ability to contribute to the plan then is going to be based on the W-2 wages that you receive from the S corp. Of course, you cannot consider W-2 wages from your day job. You can't consider owner income that you take from the S corp, right? So it's really limited to those W-2 wages, right? Specifically box one of the W-2 plus any pre-tax elected deferrals not in box one, but over in line 12 of the W-2. So your employee limit, you're able to contribute 100% for 2023 of your W-2 wages, dollar for dollar, up to $22,500 or $30,000 if you're 50 or older. You can make that contribution as a Roth contribution. Now, on top of that, you're able to make an employer contribution, right? Because you're both the employee and the employer. So the employer limit is 25% of your W-2 wages. So if you have the W-2 wages to justify it, you can make an additional employer contribution of 25%. So typically historically, those employer contributions were always pre-tax. So they were reducing your taxable income. First, at the end of last year, with a passage of Secure Act 2.0, you can now make those employer contributions as Roth contributions. But for a plan like ours that has always allowed for Mega Backdoor Roth contributions, there's really no substantive advantage. So you're better off just making it as an after-tax contribution. And that's really the bottom line. So we don't dwell too much on it.
George,
But
does everybody
yeah,
know
go ahead.
backdoor Roth?
Please.
George, can you explain a mega backdoor Roth?
Absolutely. Perfect timing. So that's our current slide. So Mega Backdoor Roth is a marketing term, right? It's an industry term. So, and it's different and distinct from a backdoor Roth IRA. You may be familiar with the concept of a backdoor Roth IRA. This is where someone makes too much money, they're not eligible to make a Roth IRA contribution. So they make it as an after-tax contribution and then move it over to a Roth IRA. With a Mega Backdoor Roth solo 401k, you're able to contribute as much as $66,000 or even 73,000. Oh, go ahead. You can't hear me?
No, go back, dumb it down, make sure it's so we don't, some of us don't know what a backdoor Roth is, let alone a mega backdoor Roth. I do because I'm one of your plan people, but make it really basic here because most realtors don't know this and they should know this stuff. So act like we've never heard it before, okay?
Okay, awesome. Thank you for all the feedback and engagement. Yeah, let's go slower then. So, so do we know what a Roth IRA is versus a traditional IRA?
We good there? We're good there.
Okay, great. So, with an IRA contribution, right? You don't have to be self-employed to make an IRA contribution, right? You could be just working somewhere, have a W-2 job, and you're going to be able to make a Roth or a pretax IRA contribution, generally speaking, right? But the limits are much lower. So, for example, for an IRA contribution, the most you can contribute is $6,500 or $7,500 if you're 50 or older. Okay. And so, with a backdoor Roth IRA, that refers to when, well, let me back up a second. So, if you make too much money, you're not eligible to make a Roth IRA contribution. So if your income is above a certain amount, which is adjusted with inflation, the rules don't allow you to make a Roth IRA contribution. So instead, as a workaround, individuals will make a backdoor Roth IRA contribution, right? So these are people who make too much money. They want to get money into a Roth IRA, but they're not eligible to because of those income limits. So what those rules state is they say, okay, if you make a IRA contribution and your income is too high, you'd have to make it as a non-deductible contribution. So it's considered to be an after-tax contribution. And then you can move it from, say, let's say you make that non-deductible after-tax contribution to your tradition or your rollover IRA or your non-Roth IRA account. And then you move that, say, $6,500 to your Roth IRA account. So you still end up in the same place, but they're required to go through this back door, right? So there's a similar type of process with a solo 401k, but it's a mega backdoor Roth solo 401k. So mega, because the limit is much higher, right? You're able to get as much as 66,000 instead of 6,500, right? 401k, because it's a solo 401k, not an IRA. Okay. So to be eligible to make a mega backdoor Roth solo 401k contribution, right? You got to be eligible to have a solo 401k. That goes back to the foundation, right? You need to be self-employed, et cetera, et cetera. And then the process is similar to making the backdoor Roth IRA contribution in the sense that you have this after-tax contribution that's made to a specific account and then moved over to a Roth account. So it's similar at that level, but specifically how it works is that you have to have a plan, number one, like ours, that allows for after-tax contributions, right? Like Mark stated, don't get confused, right? Because even though we're helping clients open up accounts to say Fidelity, Schwab, et cetera, they all offer their own solo 401k, but it's a basic plan. It doesn't allow for after-tax contributions, but our plan does. So you have to have, because remember, the 401k is a legal document. It's a legal entity. It's really the document. So you have to have documents from a company like ours that creates the 401k, but also allows for those after-tax contributions. So check the box, we do that. Then you have to follow the specific process. So we guide our clients through that process. So the after-tax contribution has to go into a separate after-tax account, right? So let's say the account's of Fidelity. Let's say the name of your plan is Smith Realtor Trust. So you've got an account at Fidelity and the name is Smith Realtor Trust for after-tax money. And then you've got a second account at Fidelity for Smith Realtor Trust for Roth money. So you're able to make that after-tax contribution into that after-tax account and then move it to the Roth account. Okay, so let's put some more meat on the bones let's talk about a scenario here, because we have a good one, which is how much money do I need? How much income do I need to make that mega backdoor Roth contribution up to the maximum, right? So to keep it, focused, let's assume that somebody is an LLC taxed as an S corp. It's just one person, right? They're not making contributions to another plan, like a day job plan. And again, they want to maximize those Roth contributions. So if this person let's assume they're under 50, right? If this person takes at least a $66,000 salary, so W-2 wages of $66,000 from their S corp, they're going to be able to contribute 100% dollar for dollar as an employee contribution. So that's $22,500. It could go directly into the Roth account. That should say Roth, not pre-tax. They could skip the employer contribution. So even though the plan allows for employer contributions, those are pre-tax contributions. So they skip that. And then they can make the difference up to $66,000 as an after-tax contribution. So let's skip ahead to a slide because we've got a good slide that talks about that. So you can see here, with the visual, right? So this person puts in $22,500 into this middle account, right? That's the Roth contribution. Then they put in the difference up to 66. So that would be 43,500 if my math is right. Because they can do dollar for dollar, 100% of their wages, right? And then they move the $43,500 from the after-tax account to the Roth account. So at the end of the day, they have $66,000, right? And let's say that they do that this year, then in 2024, which is, time flies, it'll be here before we know it. They do it again next year. Now they have over 120 grand in their solo 401k, right? So now let's say they want to go out there and invest in real estate, right? It wouldn't be much, but it's possible, right? And then the income is growing inside their Roth solo 401k sub account with the potential for tax-free growth, right? As long as they wait till they're retired to take that money out and they have the account for at least 5 years, they could take out all the gains totally tax-free because it's inside of a Roth account. Does that make it sense? Do you have questions on that?
I think we're good. Thank you.
Okay, hopefully that gives you what you were looking for. So, okay, awesome. So do we want to go to more questions now? Are there those with questions? Because we love questions.
Can the contributions be pulled out at any time, like a Roth IRA?
Good question. So no, they can't. The rules work differently. So the way that so essentially with the Roth IRA, you're able to take out the money that you put in at any time. With the Roth solo 401k, you cannot. Generally speaking, you got to wait until you're at least 59 and a half years of age to take the money out, in simple terms.
If you did, I assume there's a penalty.
Well, if you did, you're going to have to pay. If you take the money out and it's not what's considered to be a qualified Roth distribution, you're going to have to pay taxes on the gains, right? So you're going to have to take a pro rata portion of the money that was put in, the basis and the gains.
Thank you.
Absolutely. So, okay. So, now not everybody. So I'll keep going on these contributions and maybe well, since we talked about Mega, let's see if we can put any more detail. So, right. I mean, we talked about how, you can really put a high amount into that Mega Backdoor Roth. You've got to find a provider like us that supports it. There's some more compliance detail around that, right? When you move the money from the after tax to the Roth, that's a reportable event. So it has to be reported on a 1099-R. We handle that for our clients as an optional free service. When it comes to contribution deadlines, what's really cool about a solo 401k is that you have a lot of time to make those contributions. So, for example, as long as the plan is set up by the end of the year, that'll lock in the ability to make all types of contributions for 2023 anytime up until your tax return deadline next year in 2024. So unlike with a 401k plan that someone might have at a day job where they have to make the contributions by the end of the year, for self-employed people, you have a lot more time to figure out how much you can and want to contribute. So, and we kind of talked about like how you make the contribution to the after tax and then you move it to the Roth. We looked at an example of how the account, now you might have two people, in which case they'd have 6 accounts, right? Because you got to separate based on type of money, whether it's pre-tax, Roth, or after tax. Another twist to the Mega Backdoor Roth is that you could actually transfer that after tax money out of the plan to a Roth IRA. So some folks, they don't want to keep it in the Roth solo 401k. They might have a Roth IRA where they're really happy with the performance and they just want to get as much money as they can into that Roth IRA account. So let's back up and see. So we talked about the scenario where somebody's trying to maximize for Roth contributions. Maybe we'll talk about maximizing for pre-tax, right? Like the other side of the coin. Because going back to the power of the solo 401k, right? It's really being able to contribute a relatively high amount to the 401k to get the tax incentive, right? And there's 2 tax incentives on the table. One is the Roth, right? Where you're sacrificing a tax deduction benefit now, but all the gains are going to be potentially tax-free, right? Where on the other side of the coin, the traditional tax incentive of a 401k is that you reduce your taxable income now, right? So you make what's called a pre-tax contribution. So then the question becomes, okay, well, if I want to contribute $66,000 to my solo 401k on a pre-tax basis, how much income do I need? So if your self-employed business is taxed as an S corp, sticking with that scenario, your ability to contribute is going to be based on the W-2 wages that you receive from the S corp. So if you have at least $174,000 of W-2 wages from your S corp, then you're going to be able to contribute 100% dollar for dollar up to $22,500 as a pre-tax employee contribution. And then 25% of those same W-2 wages or $43,500 as a pre-tax employer. So now you just got $66,000 in your solo 401k and you just reduced your taxable income by $66,000. Okay, so maybe are there more questions? Or if not, we can keep going through the slides that we brought and pass it back to Mark.
I have a question.
Okay.
So right now I do have a solo 401 with Securities America. And I just want to give people a word of warning that I did not know about the 5,500. So in 2020, my 401 exceeded the 250. So now I'm paying a penalty to the IRS.
Okay.
For not reporting I was with a financial planner and was not aware. Anyway, I just want people to know that and really be aware that 55.
That's a fantastic comment. Yes. Sorry. Thank you for sharing. And
Yeah.
that's what's
I am
Can be
switching.
frustrating. Yeah. Are you aware of the late filing program?
The late filing program.
So the
No,
IRS has a program where they allow people who weren't able to file previously due 5,500 EZs under a late filing program where for a $500 fee, all the penalties are avoided. So you pay $500 for each 5,500 EZ that was past due, and then
yeah, I am
that's
aware.
it.
In fact, well, there's a cap to it, thankfully. 1,500 is the cap, so my CPA is on it. But I
Yeah, it
just,
sounds like you're going through the program then. Yeah, because it's capped up to 50, so it's capped up to 3 years worth of $500 fees.
yes, and that is why I am switching to your program.
All right, that's great.
Yeah. It's been bugging me for a while. But anyway, so
Yeah,
my question is then, for me, then I can just, and I'll fill out and I've been poking around your website, but I need to actually go into your community and be a part of that so I can learn more. I mean, I think I understand the really bare basics of it. But so basically I can roll everything over, right? From Securities America. I have both Roth and traditional portion. And then I can start using the Mega Backdoor this year, even. Right?
totally. Yes, it would technically not be considered a rollover, like for IRS purposes. In other words, it's not reportable. You're really just continue what they call it is a restatement. So the way that I think about it is right now you have a plan through Securities America where it's Securities America's plan document that's governing the accounts. And then let's say it's because this is very common. We have people that start somewhere else and then they want to upgrade to our plan. So when we draft the documents, we would draft it as a restatement. So we would say, okay, well, when was your plan first effective? By looking at the adoption agreement, and you would say, okay, it was effective January 1 of maybe 2018, right?
Yeah.
And so the plan would continue. So it's not like you're shutting down your existing plan and then starting up a new plan. It's like you're cutting out your existing plan documents and replacing them with our documents. So that 5,500 easy chain of filings would continue. Like we would ask for the most recent 5,500 easy, and then when we pick it up next year, we would take that information and carry it forward to next year's 5,500 easy. So it's not technically a rollover, but as part of that restatement process, we would help you open up accounts, new accounts at the bank or brokerage of choice, pre-tax, a Roth, and an after-tax now so that you can do the Mega Backdoor Roth. And then we would help you transfer the cash and assets over from the pre-tax and Roth accounts over to the new accounts for the restated plan.
But then I don't need to stay with, that's when I choose what Schwab or Vanguard or Fidelity for the new ETFs and mutual funds.
Yes.
Because I don't want to be with Securities America at all.
Yeah, you probably wouldn't be able to anyways, because I think they only support accounts for their plan as opposed to third party plans. So exactly. So you go with another company like a Fidelity or a Schwab that does support accounts for third party plans like ours.
Right. Okay. Thank you.
Yeah. No, thank you. Okay. So we'll let Mark pick it up.
Okay. Well, let's jump to investing in real estate under the solo 401k plan. So we'll keep this high level. I mean, we could spend easily a couple hours just talking about the various methods of investing in a solo 401k in real estate. So let's look at the second slide there. When investing in a solo 401k in real estate, title to the property is going to be in the name of the 401k plan. So first, you have to make sure that the plan that you have allows for investing in real estate. Obviously, a plan from a brokerage firm like Schwab or Fidelity, or even a firm like Securities America, does not allow for investing in physical real estate. The plan that we offer does, obviously. Now, you want to make sure that the plan has enough funds to make the purchase. As I mentioned earlier, there are various methods of investing in real estate. But for now, we're going to concentrate on using solely 401k funds. But other methods would include where you do it under a tenancy in common, or you can pool your solo 401k with other investors in an LLC, for instance. And then the LLC takes title to the property. But again, for now, we're just going to talk about just one method, which is where the solo 401k solely invests funds. So you want to make sure the plan has enough funds. Looking at the next slide, you want to make sure that when you make the offer, that it's made in the name of the 401k plan. So it's not made in your name. You want to make it in the name of the 401k plan. And same thing when funds are sent to escrow for the earnest deposit, for example, you want it to come from the 401k. So funds would get wired from the 401k's bank account or brokerage account directly to the escrow company. So everything has to go through the plan, in other words. Let's look at the next slide here. So at closing, you want to make sure you take title to the property in the name of the 401k plan. When you make the purchase, same as when you fund escrow, you want to make sure the funds are wired directly, so they don't get sent to your personal bank account first or your business bank account first. Now, after the property is purchased and it's under the plan now, you want to make sure that all ongoing expenses, as well as income, rental income, goes back to the plan directly. So if you have to pay a property tax bill, that needs to be paid with funds from the plan. Reason being is that the property is owned by the plan. So the IRS expectation is that since it's an asset of the plan, those type of expenses have to be paid with 401k funds. Now, to hone in a little bit more on the all cash purchase, we don't have any slides on that now, but let's just talk about it a little bit. So let's say a property costs $100,000, and the 401k plan only has $50,000 or $80,000 to make that purchase. The 401k can go out there and get a non-recourse loan. So there are a number of hard money lenders out there, banks, they're all reference, or a sample of some of those are referenced on our website that specialize in lending to a 401k. Non-recourse means that if the plan defaults on making those loan payments, that there's no recourse against the plan except for that property for which the funds were used to purchase the property. So the non-recourse loan payments are made with funds from the plan. So you want to make sure that you don't run into liquidity issues. So if you later need to transfer more funds to the plan, you can do so by transferring IRAs, former employer plans, or you're making an annual contribution. Of course, the rental income goes back to the plan, so those funds are used to pay expenses such as a non-recourse loan. And again, there are other methods, and we can always do a separate webinar on that, or even send some information on that. It's all on our website. But that's one of the main types of investments that are made under this type of solo 401k plan is real estate, whether it's commercial, residential, or even real estate syndicates. So that concludes that section. So I'll let George go over loans, unless you want me to cover this as well.
That's fine. I can talk about it. Were there any questions in the meantime? Okay, so we'll just talk about loans. So we touched on it before, but just to hone in on it, if you have a plan like ours that allows for participant loans, then you can take one. So this is different and distinct from lending money to somebody else, right? Where you're invested in a promissory note, for example. This is where the 401k owner and the solo 401k participant is actually borrowing their own money, right? So they're literally taking the money out of their bank or brokerage account for their solo 401k and they're putting it into their personal account. Now that looks like a distribution, taxable distribution, but if it's properly structured as a solo 401k loan, then it's not going to be considered a distribution. So in order to properly structure it, it's got to be limited to 50% of the balance. So let's say you had, so you add up all the value of the solo 401k assets, and then including the cash, et cetera, and then you can take a loan up to 50% of that amount, not to exceed 50,000. So as long as you got at least 100,000 in your solo 401k assets, you can take a $50,000 loan. It's got to be paid back in monthly or quarterly payments. Equal payments of principal and interest. The interest rate is either prime plus 1%, or you could use a comparable CD rate plus 2%, like the CD interest rate on a $50,000 5-year CD, right, plus 2%. We then prepare the payment schedule, the amortization table, et cetera, as part of the services, because it has to be documented as a 401k loan to satisfy the 401k loan requirement, so it's not a taxable distribution. Those payments are spread out over a 5-year term, or if you're using the proceeds to buy your primary residence, the term can be extended out to 15 or 30 years to match the term of the mortgage. I mean, of course, the loan proceeds, as we talked about before, can be used for any purpose whatsoever. So that would be a popular use case, again, for our solo 401k. We've got some good contact information here, so you could make note of that. Just to recap, and as far as some of the takeaways, right, with the power of the solo 401k, we talked about how it has the highest contribution limits for any defined contribution plan available to self-employed persons. Those contributions can be you're able to really maximize the tax benefits by either taking the tax deduction now as a pre-tax contribution or making a Roth contribution. So you got the potential for tax-free growth. You can invest it in alternative investments. You can invest it in traditional brokerage investments, or you can take a 401k loan. So hopefully that this has been helpful. We really appreciate the chance to share this information with you and to hear some of the good questions.
You got any questions?
What would be the scenario where the funds are still invested, but you're using them for real estate? Is there a scenario like that?
The funds are still invested, meaning like they're invested in a brokerage account, like a mutual fund, where you're using it for real estate?
Yep.
I would say, if you're using it for personal real estate, like let's say you personally own an investment property and you want to remodel the kitchen or something, right? So that's where you could borrow. You could take a $50,000 loan, assuming you have at least 100 grand in value of that account. But you would have to, of course, liquidate some of your solo 401k investments to fund the loan.
Sure.
That could be a scenario there. Yeah. And that's a popular scenario. And what some of the issues that come up there is that some folks will say, okay, well, I want to be my own bank, right? I want to borrow from my retirement account. I can access the money quickly. There's no credit check. I'm not paying the interest back to a bank. I'm paying it back to my retirement account, right? Um, and so those are all positives. And then I can turn around, I could use the money to say fix up this investment property, and now I can get the rental rate much higher. So you have to be cognizant though that while all of that is well and good, that loan needs to be paid back according to the payment schedule. So if there's delays in maybe fixing up that property, you're going to have to make sure that you're adhering to that payment schedule. So your obligation to pay back your 401k loan is not dependent on what you ended up using that money for. So that's where there's sometimes some confusion. Some folks will say, well, I've used it to fix up this property. There's been delays. I'm not ready to pay it back. Well, it's like, well, that doesn't fly. It needs to be paid back according to the payment schedule, regardless of what you used it for. So good question. Yeah, that's a common question.
Right now, with the prime plus whatever was paying yourself back high interest rate, you borrowed that from a bank, you'd be really mad about it, right? In a high interest rate, but when you're paying it back to yourself.
Yep. Yeah, some people will come up with good creative questions and say, well, can I pay myself more than that, right? I want to put more money in my 401k. And I want to pay a higher interest rate. And the answer is no. You really have to stick to one of these options. I mean, if you can find a CD rate that's higher to help document, as long as you can you can find that comparable CD rate and you can document it, then that would be reasonable. But within the confines of those rules, you're not going to be able to go higher or lower. Some folks will say, well, I want to go lower, and you got to stick to that interest rate. So, but as noted, I mean, the good news is it's not going to a bank or some third party. You're really just paying it to your future self because it's going into your retirement account.
Of course, you had a CD at 5.75, so you pay yourself back at 7.
I'm sorry? I didn't catch that.
About a local bank and the rate that they were paying on a CD.
Exactly, like a 5-year, like a lot of folks will go to like bankrate.com maybe, or like you said, go to just check with their local bank, like say a 5-year, $50,000 CD. Okay, what's the interest on that? Plus 2%. They provide us that data and then we generate the payment schedule,
But my mind goes to if that 50 grand is sitting in there and it's being invested at whatever the return is, there's a break-even point in leaving it versus buying. And maybe it's very clear and I'm just not following, but then it's just that if you don't want to tie up other money, then you're using that money to go take advantage of an opportunity in real estate. Versus, I mean, otherwise, like, let's say you're making 30% in the market on that 50 grand. I mean, that'd be a pretty crazy number, but
yeah.
What I'm saying, I suppose it just depends on the opportunity that the real estate provides.
So
Yeah. Yep.
down and you don't have the money to go buy a different car right now. Bond is paying what? 5% or 3%? You could borrow it and pay yourself 7. We can pay bank that rate. You have to decide. Yeah, but
I know what you mean. Yeah, no, I get you. Yeah.
So what we didn't, so just so we're part of is this part of an all-day session on wealth building that we're at? Just curious.
All year.
All year, okay. And everybody's in Minnesota, right?
Right, and we meet 1 hour per month on the 3rd Thursday and talk about different wealth building topics.
Okay, awesome. And the same, it's always the same group every Thursday?
No, we have some variety.
Okay. Great, yeah. Well, that's how you do it. You gotta be consistent and disciplined, right? Keep
Yeah.
building.
George, I have a question about asset allocation. So
Sure.
once you are, you invest and, you do the 3 pots or whatever, the buckets.
Yep.
And then you go through, Schwab, Fidelity, whatever.
Mhm.
You pretty much have access to all of those ETFs and funds, right? And does the owner decide the asset allocation, I'm guessing, or do you offer plan?
The owner does. So we're not providing investment advice, but you're absolutely right. You're able to invest in a wide range of investments at Fidelity. It's going to be mutual funds, ETFs, publicly traded stocks. It's going to be similar to like an IRA at Fidelity. And what's nice is that the brokerage firms, they don't charge anything to set up the account. There's no maintenance fee. Thanks to Robinhood, there's free online trading. So
So yeah, you just pay the expense ratio.
yeah,
And
depending on whatever that particular investment is. So, but like I said, I mean, we go live every day at the outset on our community. You can jump, you're free to join. It's always at the